Hello everyone and welcome to today's major markets update for November 16, 2022. Not too much to say compared to yesterday as there was not much progress either up or down for most indexes. So let's have a look here first and foremost to this ominous pattern where we compare, not we, but some people compare the 2008 price action with that of the current market. That suggests if this pattern continues to repeat itself, we should be in for a big fat crash. So is this likely? Of course it is possible. We'll know this happens if we break below the October lows. Okay, that's the cue that we're in this big fat crash. Something quite ominous needs to happen to suggest this is going to be the case. Something quite ominous, especially considering where the Dow Jones is. Okay, the Dow Jones is back at the August highs. So for that one to break below the October lows takes at least a 20% drop almost from 33,000 to 28,000. So that's 5,000 points on 3,000. That's almost 15-20% drop. So that is quite substantial, quite substantial. So I don't know if it's going to happen. I cannot tell you. That's not my preferred path. My preferred path is shown here. So far, so good. I see no reason to change my tune unless we start to go below this ideal target zone. All right, so pretty much below 30,750 on the Dow Jones. And I really start to question if this is the case. Then I will readjust my wave count in something that is similar to that of the semiconductors, some sort of A, B, C type of correction. And this is A, and this is B, and this is C, okay? And then we'll get the waterfall decline. For now, things still look long and strong, but we have, of course, these negative divergences on the technical indicators, suggesting we should roll over anytime soon in a deeper decline, the black B wave / 2 wave, or potentially in this more aggressive 3, 4, 5 setup. And of course, the alternative remains indeed, as I showed you, that we have this A, B, C path. Okay, that's the alternative. It will take at least a drop below 31,750 to start to suggest this is the case. Okay, I don't see it. It's possible. So in this market, please accept the fact that we are in uncertain environments because of all the overlap of all the ABCs left and right, up and down. So interpretation remains always a little harder, but it's not my preferred path. But please be aware of it. So please, I would say, have a little shorter term view than a longer term view in this market. Take profits quicker, raise stops quicker, all those things. So here then is the Nasdaq 100. It looks technically enough for 5 waves higher into yesterday's high. Yesterday's update, I already told that now is as good a time as ever for the market to top. So far so good, not too disappointing. If we drop below this orange first bearish cutoff level, which we retook last week, then I think we have a much larger or better idea of this B wave and then the C wave. Okay, so that is still the preferred path. Again, below 10,800, 10,600, and then I am more on board with this waterfall decline, but that would need to be a black swan event, and I do not know what a black swan event is. If I would know it, then it's not a black swan event anymore. So technically, there are enough waves in place since the rally of this early November low, 1, 2, 3, 4, 5, but I might be off by 1 little degree. The same here is shown for the semiconductors. Was the rally into Thursday's high, I believe it was wave 3, then Friday's decline wave 4, and then yesterday's high wave 5, or is this 3, is this 4, and now in 5, okay? So one thing we can look at, for example, is NVIDIA's earnings. Of course, NVIDIA is a large part of the semiconductors, and it's kind of like a nothing burger. After hours, it's up 1%. We really need to see a strong reaction to these earnings to help, of course, the semiconductors. So this doesn't help us too much either. So we have to simply go by price levels. If we start dropping below this green wave 4 ideal target zone, which is about 2650, 2630 to 2620, then I am all in favor for a deeper decline back to about the, what did I tell you before, 2350 level. So let's pencil that in for now. I haven't done it yet. So if we have topped out here for this wave A, then I expect a wave B to this target zone here, somewhere there. Okay, so this could be A, question mark. Don't know yet. There are technically enough scribbles in place to suggest this larger wave A is complete. Okay, so if we drop below 2620-ish, that would be a very strong indication this B wave is underway. Okay, again, yesterday I mentioned this looks as good can be, as toppy can be, and the semiconductors did not disappoint today, so far down 4%. Question then is Friday's low 4, yesterday's high 5, or am I off by 1 wave degree? I can't discern it just yet, but again, please remember where then the upside potential is versus the downside risk. Oh, thank you. Stock charts didn't save the new annotations. So then we should see something like this. Sorry about that. You can see how my work sometimes gets doubled because of incompetent schlemiels on the other side of the screen. And that is a phrase by Steve Pinkert, who called terrorists most of the time incompetent schlemiels, which I totally agree with. Anyway, that's all besides the point. So we should see something like this. And then, of course, we get our C wave, something like that. Okay. So for now, let's focus on the cutoff. Okay, 2620. Below it, odds start to favor the larger B wave. NVIDIA's earnings still okay. We'll have to see tomorrow by the open what it's doing, but 2% is nothing really that screams okay or continuously. Here is the S&P 500, has technically also done enough. We had here of the red B wave high a 3-day rally, a 1-day drop. Then we had a 2-day rally, very strong, a 1-day drop and another rally. So technically 1, 2, 3, 4, 5. We've done enough. Okay. Again, we break above yesterday's high. We're going to go to 4140-ish, somewhere around there. So the upper end of this ideal target zone. And then we'll drop. And then we rally. So it's a little bit a question mark. Did we top already? Yes or no? And as you can see, we're really stuck here between a rock and a hard place. And if we break out, then again, you can see based on simple symmetry, we can target right to the upper end of that target zone. That's around 4140. Make it 4125 plus or minus 15-ish, or something like that. 4140 plus or minus 10. Whatever you want to make out of it. We're stuck here in this little bit of a no man's land zone. Break below it, so break below today's low, which is yesterday's low, which is Friday's low, and then we can target easily the 3850s or thereabouts, 3875. All right, so also based on simple symmetry. We're stuck in this box, this blue box. Okay, so if we then break below this blue box, there we can target that. If we break above the blue box, there we can target that. So I have a little hard time yet discerning where exactly in the scribbles we are. Break below it, there, break above it, there. And then we should roll over. Please note there's a lot of negative divergences, just as I showed you on the Dow Jones chart across the charts, but divergences are only divergences till they're not. They're a condition, not a signal. Now price needs to respond to it. IWM has also technically done enough to complete this wave 5 of A. It should now be in wave B of larger B wave. So far so good. Also, yesterday's warning was so far correct, and that looks toppy. 1.76% down. It's initiation so far, but of course we need to continue to move lower. Also here we have plenty of negative divergence, but divergence is only divergence till it's not. So let's see how this is going to respond. I prefer this path. This path remains preferred, the ABC lower. How are we doing on our based indicators? The PMO buy all indicator is still on a buy or in a ideal topping zone, suggesting that the risk to the downside is no larger than the upside potential. But this can stay in the ideal topping zone for a long time. We need to now see down candles. It has been on a buy since early October. The initiation was a false signal, but since then it's been on the right-hand side. It never gave a sell signal even on that decline in October to the October 13 low. How are we doing here on the McClellan oscillator for the S&P 500? It measures how many stocks are advancing and declining. It's still positive, so the bulls are in charge. Positive means more stocks are advancing than there are that are declining. But again, we have here negative divergence, meaning we're rallying on less strength. That then brings us to the summation index. The summation index adds yesterday's McClellan reading to that of today's, and yesterday's McClellan reading was added to that of the day before, etc. So it's summing readings, and positive breadth makes, of course, the summation index rise. Negative breadth makes, of course, the summation index decline. You add a exponential moving average, and you kind of can get a buy and a sell indicator. Here, late August, it gave a sell signal. And then here in late October, it gave a buy signal. And as you can see, it's pretty okay to trade from it. It doesn't work all the time. Like every single indicator, not one is perfect. It's just the way it is. There are always false signals, but once in a while they work really well. This indicator, for example, already gave a sell signal before the March 2020 flash crash. So it has its advantages. But what it shows us is that the summation index is still rising because breadth is still positive. But it's getting quite overbought. So we're running a bit into headwind, right? We are oversold. Chances of upside are increasing. Now we're getting overbought, but it's still long and strong. So credit to the bulls, but we know breadth is declining with increasing prices. How are we doing on the new lows? The initial readings are still too high for the NASDAQ. We're above 50. We want to see it below 50. That increases the odds of continued upside. It remains in the triple digits. For the NYSE, it remains below 50. So that's good. So this glass is half full. One last indicator, it is the percentage of stocks above the 50-day moving average divided by the percentage of stocks above their 200-day moving average in the S&P 500. Okay, so we want to see a kickoff wave like here in 2009. You need to see readings into the 10s and the 20s. That is indeed a cycle 5 low. See how much stocks increased back then, how many stocks were increasing. If we then look at a little bit smaller peaks above 1.75, we see most of the time when we get this reading above 1.75, we are past important lows. Not all the time. Here in 2008, it was a false signal. We had a few false signals here in 2002, but longer term, it gave a good reading. We also had here a false signal in the summer of this year. And currently, we're not even above 1.75. So it's not too strong a reading. So it's not really the start of a new bull run like we saw in 2009, not even close. So that fits with the overall narrative that we're currently seeing. Just a bounce. So in recap, is a 2008 analogy possible? Absolutely. We have our price levels to know that that is going to happen. Of course, a break below the October lows will completely validate it, but of course, we're going to already look for prices below the ideal B wave target zone, which will give us a much earlier indication. What will cause this type of crash? I don't know. A black swan event. And if it's a black swan, we don't know. It is potentially possible. It will require, again, a drop below at least 31,750. That's the first warning. And below 30.75 is the second warning for the Dow Jones. You can still see a little bit more upside because today's candle is, of course, completely insignificant, tells me anything, nothing more compared to what I knew yesterday, compared to what I knew on Friday, compared to what I knew on Thursday. So not much new to be had. We did get the downside follow through after yesterday's suggestion that we start to look pretty toppy. So that remains my preferred path, that we're in this B wave. Again, semiconductors can still try to squeeze out another fifth wave, but it's not necessary. Okay, I think it all depends a little bit on how NVIDIA is going to do. It's still reasonably up, but nothing too crazy. Same for the S&P 500. It's stuck here in this sideways pattern over the last 4 trading days. We break above yesterday's high, we can target 4140s. We break below today's low and we target 3875. Similar to the IWM, also starts toppy, lots of negative divergence on other indexes as well. So that corroborates the idea that we have a topping pattern in place, but divergence is a condition, not a signal. Everything else looks quite toppy as well. So I continue to favor further downside. Can be quite sloppy, slow initially, but I do know if we break above this week's highs, what the next upside targets are. And that's all we have for now. And even if we break out, I still think that it is a last final hip hip hurrah before we see a deeper decline, before we start our end of year rally. Okay, so know your time frame, short term, intermediate term, long term, all those things are very short term. Versus, okay, I'm bullish for the next couple of hours is not the same as being bearish over the next 2 years, right? It's quite opposite. So we can always have this counter trend. So know your time frame, know what to look for, and thank you so much for listening. Take care, trade safe, and I'll see you all on Friday. Bye.